What if I told you investing doesn't need to be complicated? In fact, the less you stress about it, actually the better. According to a recent study, 88% of professional fund managers cannot outperform this strategy. The 3-fund portfolio is one of the simplest ways to build real wealth. Just 3 funds, globally diversified, no gambling, no guessing. If you want a stress-free way to invest and still want to come out ahead, this is the video for you. So what is a 3-fund portfolio? The 3-fund portfolio is exactly what it sounds like. A complete investment strategy made up of just 3 different index funds. That's it. 1 fund for US stocks, 1 fund for international stocks, and 1 fund for bonds. Together, these 3 funds give you exposure to thousands of different companies across the world. Plus, the safety of bonds to balance out the risk. No stock picking, no day trading, just simple, diversified investing that actually works. It's literally so simple that anyone can do it. Now, you might be asking yourself the question, why is this so popular? The reason this strategy is so popular is simple. It works. Most people don't want to spend hours researching stocks or worrying about every single market move. The 3-fund portfolio gives you 3 major benefits that makes me feel it's one of the best strategies out there. First is diversification. You're invested into over 20,000 different securities worldwide. This includes large companies and small companies, emerging markets and developed markets, all in one portfolio. That's real global exposure. If one sector or country is struggling, that likely means something else is doing well, which in turn is helping you smooth out the ride over time. The second benefit is low fees. With the ETFs we'll be talking about in this video, the expense ratio is on average less than 0.05%. That's under $5 a year for every $10,000 you invest. And those savings add up big over decades. Keeping costs low means that more of your money stays invested. And that means more compounding for your future instead of going into a fund manager's pocket. And this benefit above all is something you don't get anywhere else. Peace of mind. When you handpick stocks, one bad choice could set you back years, maybe even decades. But with a 3-fund portfolio, no single stock is ever more than a tiny fraction of your total holdings. If one company fails, it barely makes a dent. This takes pressure off trying to guess right and time the market, and lets you stay invested through markets' ups and downs without losing sleep. You're investing into everything, not just tech, not just US companies, but the total global market. It's passive, it's low maintenance, and it's one of the most stress-free ways to build lasting wealth. So let's break down what funds you're actually going to be investing in. Starting with fund number 1, the total US stock market. This single fund gives you ownership in virtually every publicly traded company in America. Thousands of them, from giant names like Apple, Google, and Microsoft to small and mid-sized companies you probably never even heard of. Now, why is this so important? The US has one of the strongest and most innovative economies in the entire world. And historically, US stocks have been a major driver of long-term growth. By holding the entire US market, you're not just betting on one sector or a handful of companies, you're betting on them all, meaning you automatically benefit from the major winner without having to sit there and guess who they'll be. Some of the most popular and low-cost options are Vanguard's Total Stock Market ETF or its mutual fund equivalent VTSAX. Both give you the same exact exposure, just in different formats. This part of your portfolio will be your growth engine. It's designed to build you wealth over decades. Next is fund number 2, the Total International Stock Market. While the US is a powerhouse, it's only about 60% of the global market. Although that's a lot for just one country, the other 40% is made up of thousands of companies, which if you don't invest in, you'll probably miss out on some big names. These span across Europe, Asia, and many other emerging markets. Ignoring them means you're leaving out a huge part of the world's growth potential. This fund gives you exposure to major companies like Samsung, that's in South Korea, Nestle, that's in Switzerland, and Toyota, that's in Japan, and hundreds of more leaders in industries that the US is not dominant. Different economies grow at different times, so having international stocks adds balance and opportunity to your portfolio. A great choice along with VTI that I personally use as well is VXUS, the Vanguard Total International Stock ETF, or its mutual fund equivalent VTIAX. Both hold thousands of stocks from both emerging and developed markets. Think of this as your ticket to owning the rest of the world. So no matter where growth happens, you're a part of it. Finally, fund number 3, the total US bond market. While stocks are your growth engine, bonds are your shock absorbers. They're designed to add stability, reduce volatility, and give you a smoother ride, especially during market downturn. When the stock market takes a hit, bonds often hold their value or even go up, which can help you protect your portfolio. They also pay interest, providing a steady stream of income that you could reinvest or use in retirement. Now, although I don't use bonds in my personal portfolio, a popular choice here is BND, the Vanguard Total Bond Market ETF, or its mutual fund equivalent VTLX. These hold thousands of high-quality US bonds, including government, corporate, and mortgage-backed security. covering the entire bond market in one fund. Your bond allocation will depend on your age and risk tolerance. Young investors may keep their bonds at 10 to 20% allocation. Some who are extra aggressive like myself may even keep it at 0%, while those closer to retirement might flip that into 40 to 60% for more protection. Bonds aren't there to make you rich. They are there to make sure you stay invested and don't panic sell when markets get rough. If you want more details on exactly which ETFs to use in your own portfolio, check out my other video where I talk about the 5 best index funds that will make you rich. In it, I break down each fund, why it's the best in its category, and how to use them to build long-term wealth. I'll link it right here and in the description below. Now that you know your 3 funds, the next step is deciding how much to put into each one. That's your allocation. The beauty of the 3-fund portfolio is that you can personally adjust it to your wants and needs. This could be based off your age, your risk tolerance, and your overall goals. So what is asset allocation? Think of it like a pie and you have 100% of this pie. You're deciding how much of it is going to be US stocks, international stocks, or bonds. If your risk tolerance is higher, you could go with a more aggressive approach with higher chance of growth. If you prefer stability, you go more towards bonds. I'll be talking about the 3 most popular and successful setups. First, if you want an aggressive approach, which is perfect if you're younger or focused on long-term growth. In this setup, you might go 80% stocks and 20% bonds. That could be set up as 64% US stocks, 16% international stocks, and 20% bonds. If you prefer a balanced approach, which is growth and stability equally in measure, you could split it evenly, 33% across the board, US stocks, international stocks, and bonds. This is simple and well-rounded, making rebalancing your portfolio really easy, which is something we'll talk about later in this video. And last, if you want the more conservative approach, maybe you're near retirement or just hate volatility, you could do 20% stocks and 80% bonds. That could be split up into 14% US stocks, 6% international stocks, and 80% bonds. This setup prioritizes stability and income over big growth swings. The key is to pick one that fits your comfort level and stick with it. You can always adjust as your life and goals change, but you don't need to constantly think about it. Now let's talk about rebalancing. Once you've set your allocation, the only real maintenance you need to do is rebalancing your portfolio. Over time, some parts of your portfolio will grow faster than others. For example, if US stocks have a great year, they might take up more of your pie than you originally planned. Rebalancing is simply readjusting your holdings to your target percentages. Let's say you start with the balanced approach, 33% across the board, 33% in US stocks, international stocks, and bonds. A year later, the US market has done really well, and now US stocks make up 40% of your portfolio, meaning international stocks are not down to 30% of your portfolio, and bonds are also down to 30% of your portfolio. That's more in US stocks than you originally planned. To rebalance, you have 2 options. You could either sell a little bit of the US stock and use that money to buy international stocks and bonds until you're back at that 33% split across the board. You can use any new contributions to top up any categories that are lagging behind, which is the method I personally use so I don't have to sell anything. Rebalancing once or twice a year keeps your risk level consistent and stops your portfolio from drifting away from your plan. The reason the 3-fund portfolio works is because it's built on principles that have stood the test of time. You're diversified across the total global stock market, so you're not relying on a single company, country, or sector to succeed. That means you're protected from catastrophic losses. These can happen when you're concentrated on just a few picks. You're also keeping costs incredibly low, with expense ratios under 0.05%. Almost all your money stays invested and working for you, not going to a fund manager or hidden fees. Over decades, that's tens of thousands of dollars staying in your pocket, and even more importantly, it's stress-free. You're not glued to the news, trying to predict the next hot stock, or worried if you need to sell or not. You've got a plan and you stick to it. You let the market do the work for you. As we talked about in the beginning of this video, in the long run, the simple approach has beaten majority of active investors, and it's done without endless stressing or guessing games. And that's why the 3-fund portfolio has been the go-to strategy for so many long-term investors. So there you have it, the 3-fund portfolio. You don't need 20 different ETFs, you don't need to time the market, and you definitely don't need to guess on individual stocks. If you stick to your allocation, rebalance once or twice a year, and stay consistent, you'll be ahead of most investors, especially the so-called professionals. Again, if you want to know about which ETFs to use in your 3-fund portfolio, check out my other video that highlights and goes in depth on the only index funds you'll ever need. I'll link it on the screen and in the description. If you found this video helpful, please like and hit the subscribe button for more investment strategies, and drop a comment letting me know what allocation you're going with. I reply to every single one. Thanks for watching, and I'll see you in the next one.